Ladies and gentlemen, welcome to Practicality, where we show and rate tools that bring you closer to your long-term goals. Today, we will present you a great book named Beating the Street. 332 pages, so it's a decent book and a national bestseller. Where can this book help you? It is a helpful tool for stock market, investing, business, money, and finance. Let's do a deeper dive into the chapters and contents of the book. Keep watching to learn how we rate this tool on practicality and readability. But before we dive deeper, if you want a constant supply of practical tools that help you reach your goals, then subscribe to our channel. Peter Lynch is the author of the Beating the Street book. He is a retired investor, used to be manager of the Magellan Fund that delivered 29.2% annualized return for 13 years. Wow! And he is also a philanthropist and wrote 2 more books. One Up on Wall Street is the first, his most famous book, and Learn to Earn. Have you read any of these books? Which goals did these books help you reach? Let us know in the comments. Let's have a first look into the chapters of Beating the Street book. The first 2 chapters of Beating the Street is about motivating us retail investors that we can succeed in investing. Then Peter Lynch does a deep dive in the years he was managing the Magellan Fund and shares lessons learned and experiences. Next, in the book, he also shares insights on how to specifically evaluate savings and loan stocks, cyclical stocks, and utility stocks. Finally, Beating the Street book offers practical advice on portfolio management and closes the book with 25 golden rules. To make some decent profit from the stock market, most people believe that you need an MBA from an Ivy League college. Peter Lynch supports that we actually don't. We can profit from the stock market when we do our research about a good business, and only after we know the business we consider buying the stock. If you own stocks, you should be prepared that the stock market dip might come anytime. If you do your research on the business and you know what you own, then you are not afraid of the dip. You're ready to ride it out, and when your favorite stocks go down, this is a signal. Jump and buy more. According to Beating the Street book, the first decision the investor has to make is if he wants to be in stocks or bonds. For Peter Lynch, the decision is simple. Stocks. Stocks have outperformed bonds for a period of 100 years. $1 invested in 1926 in stocks turned to 9,000 in today's dollars, whereas if invested in bonds, it turned to $175 today. When inflation is at 7% and long-term yields not even at 2%, then we're actually losing money by investing in bonds. However, if the situation reverts and bonds offer much better yields, as was the case in 1982, then the right decision would be to be in bonds. Peter Lynch was managing the Magellan Fund. He compounded at an annual return rate of 29.2% for 13 years. This is roughly a double every 2.5 years, and this means that $1 invested in 1977 with him would turn to $28 in 1990. How did Peter Lynch do that? As described in the book, by focusing only on simple things that he could understand really well. For example, restaurants like Dunkin' Donuts, retail stores like Body Shop, saving and loan stocks like Fannie Mae. The process he followed to understand all these companies is similar to the research of a reporter. Make sure you have enough time to research all the stocks you own. You must read the public documents for clues, get more clues from talking to investor relations and analysts, visit companies, ask the business how they plan to grow earnings next year and who are their stronger competitors. After you gather all this info, you must be able to tell the story of each stock in 90 seconds or less. According to the book, stock picking is art and science. Let's discover Peter Lynch's practical guidelines when to buy a stock. You want to start from graphing stock price and company's earnings. When the stock price of the business is at or below the earnings line, you want to buy shares. You don't want to buy shares when the price line diverges up or when fundamentals are deteriorating. But there is also the perfect buy. When earnings increase and price keeps falling actually. This is exactly the period that legendary Warren Buffett was buying this stock. Can you recognize this business? Let us know in the comments which business you think it is. Now, dividing the two lines, we get the P/E ratio. A good price per share is when the stock sells at or below its earnings growth rate. But before you buy the stock of the business, the investor should look at the balance sheet. The balance sheet must balance, so assets minus liabilities must equal equity. Here, equity is $93 billion, of which $84 billion is held on cash. Whether the remaining $9 billion of equity is reliable will actually depend on the nature of the business. For instance, how valuable is the inventory? Does it have any value at all, or is the inventory outdated? What about goodwill? Goodwill means that the company did some acquisitions. Can the company recover the money it paid to do these acquisitions? And finally, what about liabilities? This business, for instance, has $32 billion of debt to go together with the equity. According to Peter Lynch, debt over equity shall be smaller than 0.5 to have a healthy balance sheet. Let us know in the comments how much is the debt to equity ratio for this business. Probably now you are wondering why debt is dangerous for a business. Because actually, if the company has problems, then the bank will ask for its money back. And this might lead to business bankruptcy. Biggest losses come from stocks with poor balance sheets, so always look at it. Stop. On this topic, Peter Lynch also shares in the book a personal story from his career when he was traveling abroad for business. In Sweden, he discovered a company named Volvo. Most probably you know this company, and the company was selling for $34 a share. By looking at the balance sheet, he found that Volvo had also $34 net cash per share. So he was getting basically all the other assets of the company for free. He immediately bought the stock. When you find a bargain like this, act quickly. Next, Peter Lynch on Beating the Street book explains how to identify great businesses. First, avoid hot stocks in hot industries and look for stocks in lousy, stagnant industries. These are parts of the market that bigger companies have overlooked. You want to find the low-cost operator, and you want to find a business that have very little or almost no debt. Also, the business shall have little capital spending required. You also want to find businesses that they have well-paid and motivated employees, and businesses with a moat, with a niche that they can easily protect themselves from competition. You want to find reasonable executive salaries and insiders buying the stock, and you want to see a commitment to frugality from the business. You also want to see ability to grow more by, for instance, cutting costs and improving margins. And finally, you want to find businesses that they sell picks and shovels of something popular. You might think now, and if I cannot find a great business, what do I do then? Peter Lynch in his book has the answer. If you cannot find any companies that you think are attractive, put your money in the bank until you discover one. Peter Lynch in Beating the Street book also offers suggestions on when to buy S&L stocks, cyclical stocks, and utility stocks. You should consider buying an S&L business when the company trades at a good PE or if it trades below its IPO price. Also, Equity to assets ratio must be greater than 7.5, and it's even better if the company pays a dividend. Finally, an important parameter for S&L stocks is if they have small percentage of high-risk assets and defaulted loans. For cyclicals, you should buy them when PE is high. This might be counterintuitive, but this is because the company just passed the worst and the uptrend will likely start. Don't buy cyclical stocks after many years of record earnings and when PE is low. This is a sign that the prosperous cycle is over. Next is the balance sheet. The business should have a strong balance sheet to survive the next downturn. A rule of thumb here is that free cash flow shall be more than capex together with dividends. Finally, you should pay attention at recessions and be willing to invest more in the stock at the lowest point. Utility stocks. First, disaster strikes and loss of earnings occurs. This makes the stock drop a lot. Then the business management responds by, for instance, cutting the costs or reducing or even eliminating the dividend. If management efforts succeed, then the company will start earning something for shareholders, and this means that the dividend is restored and the stock price will likely go up. Peter Lynch in Beating the Street book presents also portfolio management guidelines. The process is simple. First, you want to list all the companies you have in your portfolio, and you want to basically compare the current price of the stock with your average price and write down the performance you had in the previous year for each stock. By the way, we can send you this template for free. Just send us an email. Now moving on, every year end, the investor must find reasons that next year the company story will be better. The story must answer one simple question: can the business have better earnings next year? Now the final step is to decide the action you're gonna take for next year for each position of your portfolio. Based on performance and story of each position, there are generally 3 actions to take. You can hold the stock, you can sell the stock, or you can buy more of the stock. In summary, we have reviewed Beating the Street book from Peter Lynch. It is definitely a practical tool for investing, for money, for business, and if you want to learn more about stocks. We give it a practicality score of 4 stars and readability of 4.5 stars. Definitely worth reading that book. Ladies and gentlemen, thank you so much for staying until the end. Please subscribe and press the notification bell to get all the content, and until next time, keep working on your goals.